So there was a big discussion last week on X. A lot of folks got involved, and there's a discussion that's been ongoing for, I think, pretty much 6 months, maybe longer, mostly headed up by Gary Black, where Gary feels that Tesla should start sending back some of that cash to the stockholders in terms of stock buybacks. I guess it's not really returning it to the stockholders, but potentially raising the share price based on reducing the amount of outstanding stock. Well, so that back and forth has been going on, and a frequent guest on this show, Larry Goldberg, was very much a part of the back and forth and put together a very, very outstanding set of slides, which help all of us maybe to understand better what the options are, et cetera, with regard to having such a huge cash largesse. Larry, thanks for coming on and helping us to figure this out.
Thanks, Randy. And, to be fair, we should definitely reflect what Gary is saying about the share buyback. I mean, his point is that at current share prices, if they buy back their shares, the increase in share price we all anticipate in the next 2-3 years will mean that they're reducing their share count at a significant discount to their net worth, and that will enrich us all and will add to the value of the shares. And he thinks that this will encourage institutional buyers.
Right.
And that's very good. I mean, in theory, he's correct. Not in theory, in practice, he's correct.
Right.
And I don't critique that at all. I think that's a very solid grounding. And not only he, but several others have made this point, and some of them quite strongly. I don't think it's just simply people looking for a short-term bounce in the stock. I think it's a practice that has become fairly normal, particularly in what we call the Magnificent Seven, and that's stocks that have done so well recently. And these are, for the most part, these are stocks that are the very pinnacle of the innovation, innovation that's happening right now. They're enormous cash generators, because their principal product, for the most part, not all of them, but the principal product is really intellectual property. So either media or software, or some form of intellectual property.
Mm-hmm.
Go ahead.
So famously, we've heard even Steve Jobs say 15 years ago, he would say things, well, not even, I guess it wasn't 15 years ago, probably would have been more like 8 years ago, famously said over and over again, I don't have any place to invest all this money. I don't want to buy a bunch of larger companies, not interested in going that direction. So there are a number of different ways that when you have that kind of cash flow and already have that kind of cash in the bank, there's a number of things that you can do with it. Among those, one of which is buy back stock. So why don't we talk about, before we talk about the specifics of buying back or what Tesla needs the money for, what are some of those options? What are some of the ways that companies can spend the money?
Well, you can invest, you can buy a company, you can invest in, expanding your business, you can add product to your company, you can have expansion by way of geographic expansion, by way of expanding your product line, by going into new businesses, or by adding depth to what you're doing by way of geographic. There's so many expansion possibilities for a company. But if you feel that you don't want to significantly increase your product line, or you don't want to add to the markets that you're serving, or you don't want to invest in acquiring companies, if these are not options on your plate, and you have sufficient cash to operate your business and expand your business at the rate at which you're comfortable expanding it, and that you feel your products justify, well, then you've got spare cash.
Yes, and also ameliorate any potential risks.
Yes, that too. But I mean, in general, this is a decision that management makes based upon, the nature of the business. The point that I'm making is that this is not the time. It's not the time from from the point of view of business expansion, and it's not the time in terms of the industry uncertainty. And it's not the time in terms of economic uncertainty. Economic uncertainty, I think, applies to everybody evenly.
Right.
But the auto industry is the subject of enormous, change right now. And so for them, economic uncertainty is maybe even greater than for most. But I'm already getting ahead of myself because I'm making the arguments. The point I'm trying to make is that, in general, my thesis is Tesla faces its biggest expansion ahead of itself. I mean, it's gone through massive expansion, but it faces a much larger expansion in the coming years than it's had in the last couple of years.
And go ahead. No, go ahead.
In both geography, but in TAM, in terms of its product range, and in terms of multiple businesses that it is incubating simultaneously.
Yes.
So these factors mean that its cash pile, which is sitting at about $21 billion, which sounds like a heck of a lot of money, is actually not a lot of money.
Yes.
And I've got some numbers to prove it.
All right. And Larry, I didn't 100% see the entire slideshow that you've put together, but I was wondering before we start, because I think this is a critical aspect, do you talk in there about Tesla's amazing return on invested capital?
Not direct. I mean, I don't mention it directly, but you'll see from the numbers that the capital investors comes back in profit very rapidly. I mean, we're talking about a couple of years.
Right.
My point is that even though their investment returns very rapidly, I mean, out of all proportion to anything done in the auto industry,
any manufacturing industry ever, probably.
yeah. Well, Henry Ford did pretty good in that regard, but it is an amazing story. And, it's kind of the NVIDIA story as well. I mean, NVIDIA is doing that as well. But they have, for an auto company or a company that manufactures a large, complex product, it's truly amazing. But they still need the cash before it turns to profit.
All right. So on that note,
yes,
share your screen and let's jump in and
will
see your analysis. Because I did see the basics of the analysis yesterday and was totally impressed by what you'd put together. It had to have been a labor of love because it took a minute.
Well, it certainly did take a minute. That's a fair statement, and it was certainly a labor of love. But it's something that that was valuable for me to do because it certainly helped me understand the situation. Do you see my screen?
I do. You're looking great.
Okay, so the first thing I want to do is stipulate that this is not my business plan. This is Tesla's business plan.
Right.
And I go right back to the Investor Day deck, which is the Bible for me, for Tesla. And until they tell me otherwise, it's what their business plan is.
Right.
And I want to start by saying what their allocation policy is. And they believe their capital allocation first goes to daily operations, working capital, captive financing, and downside protection.
Right.
Not a lot of people understand downside protection, but fortunately, Elon Musk does. And his management, in fairness, this is a lot of people contributed to this.
Oh, yes. And again, I've said this on my program over and over and over again, because I have studied recessions. You and I have talked about this before. The number one thing you need if there is going to be a recession of any size is cash in the bank. That's the number one thing. Yes.
And Randy, old farts like us tend to talk about defensive postures more than young people.
Right, exactly.
And to be fair, the last 20 years, despite the 2008 crash, but the last 20 years have been halcyon days for most people. You had, 2 years of crash in 2008, but really people have been brought up to think of cash. Oh, it's something you just arranged with the bank, or
Yes,
something you just, yeah. That's not always true. So that's daily operations. And then once they've covered their daily operations, they're looking for growth, R&D and capital expenditure. And then, and by the way, nobody is as efficient in its capital expenditure as Tesla. And we've spoken about this before, but when we look at the capital expenditures of the BYDs of this world, or the Volkswagens of this world, or almost any company you wish to name, none of them are as efficient with their R&D as Tesla is.
Their ROIC is 30. That's the last number I've seen. The only company in the world that we know of right now that's higher is Apple at 50.
Well, I think NVIDIA is probably there too now.
They might be. Okay. And then we also have the rate of growth requires more cash. So if you're growing at 10%, it doesn't take as much cash to grow. When you're growing at 50% a year, and that's your expectation, just in automobiles, that doesn't even count energy and all those other categories. It takes more cash to grow at those kind of levels.
And the auto industry is much more cash intensive.
Yes.
By an order of magnitude than so many of these other innovative companies in the so-called Magnificent Seven.
Right, right.
And by the way, I include NVIDIA there because NVIDIA does not manufacture.
Right.
NVIDIA subcontracts everything as do Apple.
Right.
And then opportunistic. So, the opportunistic thing is just what are the opportunities that present themselves because of economic conditions, or because of competitive conditions, or because of changes in the marketplace and acquisitions that you can do. And also, what can you do by way of reducing debt and reducing the cost, reducing the debt quantum by perhaps prepaying the debt and so on.
Yes, and you have these opportunities with a company like Tesla. You have way more opportunities than almost any other company, again, on the planet, because everybody in the space that Tesla is in, and it's in a lot of spaces, it has a lot of products in a lot of different categories right now. When you're in all those spaces, and these are kind of the leading edge spaces in business today, then people who are barely remotely inclined on bringing a new product or service to market are hoping that Tesla will become their customer. I mean, when I was making bicycle water bottles, I was hoping that Walmart would become my customer. This is who you're looking at. This is who you got in your field of vision as, this would be the killer deal that I could put together. Well, if I'm building a new battery type, or I'm building a new wheel, or I'm building a new anything to do with cars or batteries or anything else related to what Tesla does, I'm hoping that maybe Tesla will give me a look.
And this is a very important component of the opportunistic area. So, family, they just bought Wiferion simply to acquire those people.
Right.
They have the optionality to do that. So the optionality is the cash that you have in the bank and the lack of debt.
Right.
And then ultimately, with the excess, once you've taken care of 1, 2, and 3, you can do the 4, the excess. Now, my contention is that we aren't beyond 2 yet.
Yeah.
Everybody says, "Oh, we're already at 4." We're not. We're at 2, and I'm going to show you that in these couple of slides.
Now, by the way, having said that, you believe that does not mean that they don't have enough cash right now to be opportunistic. And they have been and shown themselves over and over again. Like, for instance, with building the refinery down in Corpus Christi, that was something they had no plan to do, but all of a sudden they realized this would be a good thing, a good opportunity, and they had the cash to do it.
Well, when you look at opportunistic as 3, opportunistic really applies all the time.
Right.
You always have opportunistic, you always have the option of opportunistic unless you don't have enough working capital. So with the exclusion of working capital, you can really use this opportunistic option at any point, you know, in the cycle. And the point about opportunistic is that the more you shave away the excess, the less opportunistic optionality you have.
Right.
And that's one of the issues I have about shaving away excess right now. But I'm going to show you that the excess is a very, very thin margin. And that's my whole thesis.
Yeah.
And the whole difference between myself and Mayor Thaker and, you know, Gary Black is that they believe we've got all the money in the world in the bank and that the cash flow is going to continue flowing, and therefore we can pay some back, and that we still, you know, have the ability to grow. I'm going to show you it's a little thinner than that and far too thin for my comfort. But if you're a young man, maybe you're more you know, maybe you have, you know, more optimism.
Well, Elon has said, take your risks in your 20s and, you know, or even your 30s. And Elon was taking his risks right into his late 40s. You know, so
well, he took a huge risk at 50. Yeah. You don't buy Twitter and call that no risk.
So, yeah, all right, let's go on.
And then Tesla says that they're going to invest $150 to $175 billion to reach 20 million annual vehicle production, 1 terawatt of annual energy storage production, and provide for cell production. And they reckon it's going to cost them between $150 $175 billion, and they've invested 28 billion of those as well. So this means that they have 140 something to go, 140 billion dollars to go
between now and the end of the decade.
Between now and the end of the decade, and towards that, they have amassed $21 billion.
Right.
Now the question is, can we just give away 10 billion or 3 billion or 2 billion or some billion of those billions to our shareholders? And is that a good thing to do?
Right.
Gary says, Mayor says, yeah, let's give back, you know, a couple of billion of that because we're just going to accumulate more and more. Well, this is the crux of the conversation, and he's comfortable. They are comfortable, I believe, with where we are. I am not. My contention is we have $120 billion of commitment on hand.
And Larry, let's also say, which I'm not sure that either one of those gentlemen would suggest is a great idea, but if we did come up, we have to, if we're fair and balanced, if 3 years from now we were short of capital to get the expansion that we're looking for, since there is no since there's no bank borrowing to speak of at this point, they could go to the banks and borrow substantial amounts of money for any such expansion, and or
unless
they could go to, yes, I'm sorry, let me finish.
Unless you believe, as I do,
yes,
that borrowing is going to become increasingly more difficult because you're competing with the US Treasury, who have to borrow trillions of dollars in the marketplace.
Right.
And
but can we say, Larry, that in a normal environment, that would be a major option? You could borrow the money from the bank. You could float bonds. There's ways that you could raise the money, and you could also float more stock. You could also go the opposite direction and go ahead and go back to capital markets. So there are options. I'm just saying, to
capital markets are always the option. But I want to tell you, if I'm in the auto industry today, and I'm going to get to the question of the state of the auto industry and where the auto industry is going,
okay,
then I will tell you, if I were in the auto industry today, my mindset would be the last place I want to go to get money is the capital markets in the next 3 to 5 years.
Okay.
Because we are going to go through a crisis a la 2008 in the auto industry, where nations are going to have to bail out national auto companies.
Right.
And
I think
financing,
yes, we can all agree on that.
right. And so these are unknowns that no reasonable strategic thinker would be considering. And I will point to you this simple statement. We expect our pace of investment to scale with operating cash flow growth.
Even so, yes.
So we're making a statement up front. Guys, we want to be self-sufficient.
Right.
And I really think that that's the right way to think about it right now.
And I think that that's Elon. There's a piece of him that really, really likes that. I think there's a found, maybe even a first principles part of him. Larry, I don't know if I ever told you the story of this guy I met years ago. He was worth $10 billion when $10 billion was a lot of money. I went to visit him at his house, and I said to him, you know, how did you do this? He says, well, my brother and I, when we started this plumbing distribution company years and years ago, we decided we would just grow it 10% a year. And always do it with our own cash. And I'm thinking, I never had a plan to grow any of this is at 10% a year. It was always 30, 50, 100%, you know. And he's like, no, he said, you know, over time, if you grow at 10% a year, you'll get there.
Yeah, you'll double every 7 years. So I mean, the company has stated it's going to grow with operating cash flow. So we have to live within our means, and we have to find $150 billion.
Right.
Okay, let's make some reasonable and rational, projections.
Yes.
And I want to use this slide to stipulate that Tesla have made extremely rational projections. And we start with their projection in 2013, actually 2014.
Right.
February 2014, they said, we're planning to supply 500,000 vehicles in the year 2020. This was in 2013. They produced in 2013 22,477 vehicles. So yes, they were projecting, or literally 6 years in the future, they're producing at 20 times growth.
Right.
They hit the number almost on the head.
Yes.
I think they were short about 400 cars. And then they said, at the very same time, we're planning to grow our manufacturing capacity as quickly as possible. Over a multi-year horizon, we expect to achieve 50% average annual growth in vehicle deliveries. They said some years a little bit more, some years a little bit less, but overall 50%. And look what they've done. These orange bars represent their projection. These gray bars represent their results.
Right.
In summary, despite all the doubts and despite all the skepticisms and despite all the negative sentiments about Elon's projections, they have hit the nail on the head every single year.
For a decade.
For a decade. 2013 to 2023 in the auto industry.
Right.
I mean, this is a record I don't think has ever been equaled. But, when you look to the future, you really face the law of large numbers. Because the larger the number gets, the more impossible the growth gets. You can't just keep linearly growing forever. Otherwise, you'll just consume all the available resources in the world.
Yes.
So in 2024, I think they're going to hit it or very close to it.
Well, Larry, can you explain these first?
Yeah.
This is where the other day when you showed me this, I got a little thrown off. So what's each bar? Yeah.
This orange is output from existing factories. Okay. I then start adding output from new factories in the gray bar.
Okay.
You see the orange bar grows somewhat and it reaches, a top level because Austin is so elastic in growth potential.
Right.
Austin's got enormous growth potential. Berlin's got quite a big growth potential as well, but Shanghai maybe reached a limit of in terms of its physical space, and they'll have to get more space. So the gray bar is Nuevo León and Mexico, the Mexican thing, and other new factories, because once we get to 2027, 2028, we'll have to have more gigafactories over and above the existing factories. So the orange bar is growth of the current factories.
Yes.
The gray bar is my putative, new factories. I think we'll hit the growth number in 2024. I think we'll miss in 2025, because they said we'll miss in some years.
The blue bar would be
the 50%.
What you need to do, the number you need to hit. Okay.
Yeah, the blue bar is what you need to do to get the 50%.
Okay.
Okay, so I think we'll hit 2024.
Right.
2025 and 2026, I think, will be our misses. 27 and 28, we're going to hit 50%. I think we've got the runway enough between now and then to build those factories and add those productions. And of course, Mexico is it. So I'm assuming that, the new manufacturing methods are built in Austin, perfected in Austin, implemented in Mexico, and then it grows dramatically. Right. And then we have another new factory opening in probably India, I guess, and then we hit that number in 2028. By 2029 and 2030, I don't think we're hitting the magic number anymore, because in any case, our goal is 20 million. I think we get to 20 million quite comfortably without having to hit those targets.
Right.
So this is kind of my straw man.
Yes.
But this is the minimum straw man we'll need to achieve the goal that Tesla has set.
I was going to say, and you have to take into consideration that he said both things: 50% per year average growth and 20 million in 2030. So the 50% per year annual growth, as you point out, is impossible to do for even another 5 years. Probably you would be larger than all of the car companies times a multiple.
Yeah. Now we have to talk about, now that we understand what the target is and where we have to get to, we have to talk about how much cash is going to be needed from these internal resources to build this thing.
Right.
So I want to point out to you, now everybody's thrown into my face, oh, well, Tesla said this is the amount of money they're going to put into capital investment next 2 years.
Right.
Well, I want to show you a slide that I didn't produce. Bloomberg produced this. This is what Tesla shows. This is what Bloomberg shows Tesla's 10Ks have projected in terms of CapEx. Okay. In April 22, they said, next year is going to be 5 to 7 billion.
Okay.
Then it jumped to 6.8 billion in July. Okay. From April to July, it jumped from 4 to 6. And then in April 23, it jumped to 7 to 9.
Okay.
I think we're going to see several jumps.
Right.
So what was originally 5 to 7 has become 7 to 9. It's jumped $2 billion in a year.
Okay.
Exactly a year. I think it's got a ways to go.
Right.
Here is my projection of CapEx versus profit over up until 2030. Remember those gigafactories we're opening and the expansion of the existing factories? These red numbers reflect that. So, this 24 and 25 is baked into the 7 to 9 that they've already projected. I haven't allowed for an increase, although I think there's going to be a $2 billion increase. I think probably I should up these numbers. Okay. 2026 is a major jump because we start introducing the new gigafactories. You remember my projection of revenue?
Yes.
And then the big numbers come in terms of investment. This red number reaches its limit. And this is the point at which we're actually spending more money than we're earning in profit.
Got it.
and then it starts falling, and the profit keeps rising.
Yes.
And this is the halcyon days, 2030, we're pretty much built out. It's going through the roof.
Right. And this doesn't, of course, all of this is without taking into consideration FSD, our robotaxis, our Optimus. So, or even
no Optimus, no FSD, no energy.
Right. Oh, no energy. Okay, this is cars
No,
only.
this is the car company.
Okay.
So the car company has to stand on its own.
Okay.
It is the largest consumer of capital. It also ultimately may be the largest generator of cash.
Right.
But it has to stand on its own. You have to look at each investment on its own. And, this is where the bulk of the money is going into. Now, the batteries are kind of subsumed into this, and they help generate, enormous cash flows in terms of the batteries.
Right.
But, that's a separate business. It has its own life cycle, blah, blah, blah. But, in looking at the actual investment plan,
yes,
this is the car company component of it.
Got it.
And what it's telling me is that I am planning to invest $35 billion $35 billion in fiscal 2027.
Okay.
And $15 billion in fiscal 2026. I better have access to $50 billion in those 2 years.
Right.
Now, financial planners and investment analysts who could care, they care, but really they're doing numbers on a spreadsheet. 50 billion, the earnings are this and the returns are that, what the hell? When it's your money and it's your business, you first think of the 50 billion, then you think about the income.
Yeah.
Otherwise, ruin, because
right.
that's how many companies get ruined. They think about all the income they're going to earn. They don't think about the expenses they have to pay.
Yes. Or the potential, again, let's say, for instance, that some kind of world situation, they can't make the margins. And all of a sudden you've got a flat year.
Or they don't sell that year because there's a war.
Right.
Wars could happen. And
pandemics. Who knew?
Whatever. But when they make a plan to spend the money, the only thing that is certain is that expenditure.
Right.
Not the income, the expenditure.
Right.
So if I'm running this company and I'm looking at a CapEx that says $120 billion, I want to make sure I've got a really solid base for that. And as you'll see, it gets very thin. And to set up the story of how thin it gets, these slides take a little bit of understanding. The blue bars here show you the total amount of cash on hand or free cash in the company at the end of every quarter.
Okay.
The green bars show you the actual cash flows for that quarter.
Okay.
Okay. So what it's saying is that, in this quarter, we actually had a negative cash flow, and you'll see the cash went down a little bit.
Right.
Then our cash flow went up and our cash flow went up. So, the halcyon days of 2021 are behind us. 2020 and 2021 are behind us. We're now creeping up a little bit in our cash position, but not by enormous quantities, not by $1.5 billion a quarter, maybe $1 billion a year or maybe $1.5 billion a year. But this is entirely predictable.
Okay.
And we are going to, our cash is going to rise a little bit, and then it's going to start falling quite dramatically in that critical year, in our previous slide. Okay. Does that make sense?
Yes, it does. Absolutely.
And, I think that this quarter is actually going to be negative cash flow.
Interesting. All right.
So there's another factor that hasn't been mentioned yet, because we've just looked at the endogenous circumstances, everything related to the company.
Yeah.
But there's exogenous circumstances, things happening outside our realm.
Yes.
And that is within the realm of the auto industry. When I say outside Tesla's realm, but the auto industry is about to undergo enormous disruption, primarily because of what Tesla's been doing. But the availability of huge cash resources will be as important in defining the winners as great technology and manufacturing ability. Optionality. I often use that word, but it is the greatest luxury for a strategist.
Yes.
When you have options, you have power.
Yes.
As your options diminish, your power diminishes.
Yes.
So it is very important.
And as your cash increases, your options increase.
That's exactly right. And let me tell you, it's very interesting, but I think Tesla may have to raise money.
Interesting.
Even with this balance sheet, even with these cash flows, even with all that I've been talking about, I think Tesla's going to have to raise money because the options are going to be so interesting and so amazing that I think they're going to do a deal that's going to involve having to finance something very significant.
I see. Okay.
But, maybe not. But the last thing they want to do is reduce their optionality in these circumstances.
Right. Right.
And I haven't talked about recession because I think that having a fortress balance sheet makes that kind of conversation spurious. And that's the greatest luxury to have.
And while we're on the subject, just to take a brief 30 seconds, would you think that the legacy auto businesses, much less the startups, of course, a lot of the startups are going to die. That's normal. But the big legacy automakers, do you think that the crisis will be pretty well done? When I say done, winners and losers by 2027, 2028? No, you think it'll go on past that?
It's going to drag on for bloody ever because, these are national, these are national, what do they call them? National, these are companies that, Volkswagen is owned by the state of 20% owned by the state of Bavaria, I believe.
Yeah.
I don't know if the number's exactly right, but the state of Bavaria has got a real big number in it. China kind of has sponsored its champions.
Yeah, yeah.
And then you have the US has got this big investment in GM and Ford.
Mm-hmm.
So you have these national heroes, and don't forget Hyundai, the Japanese champion.
Hyundai, South Korea.
South Korea, and then Honda. Well, Toyota is the Japanese champion. So when you have national champions, then somehow their survival. And talk about national champions. What about Citroen, which is Stellantis? So it's very difficult to foresee what's going to happen as this thing plays out.
Okay.
It's going to play out, but who knows?
Yes.
So, but that's the unknown components of this, and the opportunities that will arise, but also the threats that may arise. And then, the EV auto market, autonomy, the newly emergent alternate energy market, the market for autonomous human form robots, and AI, each of these are going to be very profitable businesses, but they're going to need investment and nurturing.
Mm-hmm.
Except for energy, these other pieces are not really making profit yet.
Right.
And they're going to need investment. And I haven't done the work. I've done the work on the auto company. I haven't done the work to see how much investment they need.
Right.
But if you take the 120 billion in total, and we've only, chipped away at it at this point, and we're hoping these revenues and these margins hold, these average car prices hold to, what I've assigned them, and we hope these margins hold.
Right.
We hope this 10% profit margin holds. And if it does, our cash gets down to about $15 billion, maybe a little bit less, but it's a very thin margin to manage a almost $1 trillion business.
Right. Yes.
So for all these reasons, I think we're not beyond number 3 yet. We're in 1 and 2. We're certainly beyond 1.
Right.
Kind of in 2. We have the optionality, some optionality from 3, but we are nowhere near 4 yet.
Gotcha. Okay.
Just my view. And it's the view of somebody who looks at the strategy from inside the company, not investment guy outside the company. He's taking a bet on the company, and really speaking, is looking for the company to be more liberal in terms of its payouts. But I think we have to think strategically about these businesses that they're operating.
And I think also people make the argument that somebody just made the argument last week that can't remember who it was, but it was a fairly big player, that Tesla wouldn't have survived without Elon the last 3 years. And I think there's certainly credible evidence for that. Going forward, can Tesla be an Apple situation if Elon decided to go back to his own planet? Do they have the Tim Cook ready to go? Maybe, maybe not. But for now, we're assuming Elon is certainly through the end of the decade, and he's going to run it. So you want your CEO to have a comfort level on issues that you can control. And if you can control the cash, and if that's an issue for him that provides him a comfort level so that he's not worried about that's not something he wakes up in the morning thinking about because it's handled. I think that's something you do for the CEO.
Yeah, I broaden that a little bit. I really say only Tesla management. I don't want to personalize it to Elon. I think that, when I looked at those 15 guys on the stage on Investor Day and listened to them, each one of them, I could see that we were far beyond just an Elon company. This is a company with enormous management depth. And only that management can fully understand the risks and the opportunities they face in their own business and their business plans. And they are the appropriate decision makers on the issue. Now, if the company had shown, poor management, if businesses had wandered the desert, if things weren't going well, then sure, active shareholders should come in and take over and insist on, reform. Who would want to reform what Tesla's doing right now? No. I mean, they're doing magnificently, and they're doing it because one of the very last things they have to worry about is cash on hand.
Right. Which only 4 years ago, was a really significant worry.
And, I don't think they've been through production hell yet. I think the production hell of the unbox process and of the 4680 batteries really to me, is indicative of the production hell we're still to go through.
Gotcha.
And remember what Elon has said. We covered this in, I think, a previous conversation, but the very last thing is you automate the process.
Right.
I think they're still on step 2 or 3 of this whole 5-step process, the unbox process. It's early days.
Right.
So until that process is done, we can't, when I go back to that slide that talks about, the cash coming in and the sales going up and, invest. I wouldn't say I don't say it's the perfect scenario, but I'd say it's a comfortable scenario. I don't know that we're going to go through comfort in the scenario.
Right.
So when you get down to a $15 billion cushion,
right,
that's not much of a cushion when you're trying to support a $500 billion company.
Right. The first ever in history, $500 billion company. I guess Walmart is somewhere around there. I think they're in the 500.
Yeah, but I mean, that's a retail company. I'm talking about a $500 billion order. Right. Manufacturing company. Wow.
Very interesting. All right. Is that the end of the slides, Larry, or is
That's all I got.
that's all you got? Well, that was enough. I think that was very, very, it was a great way to show folks what's going on that I had that was not in my head. And so I'm guessing that most of the audience hadn't really thought this through that thoroughly. So it's a great service to the community, Larry. I appreciate you as always. And
well, I guess we'll meet again.
okay, all right. Thanks again for being on the show. Follow Larry at Tesla Larry, and and for the rest of you, would you? I guess I just would finalize today by saying it's been great talking to you.
Thank you, Randy. Take care.